that issues relating to shipping and air transport in Article 8 of the Project Treaty. 5.1 is a case of a Dutch shipping company who had ships which came to Indian ports about 7 times during the year. These were unscheduled trips as and when required, either to drop off or to collect cargo. So there are two angles here, the dropping off of cargo and collecting cargo. So it is both imports into India and exports from India. Now the question is, what is the tax position of this Dutch company in India? And you can look at this both under the Income Tax Act and under the tax treaty. Now, on the IT Act, as you may know, we have two sections which is specifically with shipping income and shipping profits. One is section 44B and another is section 172. 172 says that before any ship leaves India or leaves the port of India, it must pay tax of 7.5% of the freight. So it's somewhat like a withholding tax. And 44B says that in case of a foreign shipping company, non-resident shipper, it's a presumptive taxation regime, and this tax will be in two parts. One is it is 7.5% of freight paid for goods that are shipped at a port in India, and second is 7.5% of freight received in India. So it's part A and part B in 44B. So based on this, the question is, this company, how will it be taxed under the Income Tax Act in the first place if we don't consider treaty for the time being? The point to note over here is that the ship is dropping off cargo and picking up cargo, so it's exports and imports. Which is 44B and 172, it says the goods which are shipped at a port in India and not shipped to a port in India. This statement means that only export cargo is covered and import freight is not covered. So neither of these sections covers import freight and both cover only export freight. Now, this ship has done both. Now what about the import freight? Is it taxable? Is it exempt? For that we have to apply the normal tax principles of section 5 and section 9. If it accrues in India, it is taxable, otherwise exempt. Now, a journey from the US to India, the very tiny part will be in Indian waters. So basically, it accrues outside India. There's one tribunal case on that also in the case of Reliance, which confirms this view that import freight is not taxable, even under normal provisions. Now coming to export freight, on the Income Tax Act, this 7.5% tax will apply. Now there's one point over here, there's one Kerala High Court case which explains these two sections to say that 44B applies to regular shipping business and 172 applies to occasional shipping business. Now why have they said that? If we go further, we see that section 172, it's in chapter 15 of the Income Tax Act, Part H. Chapter 15, Part H. And the title says profits of non-residents from occasional shipping business. That's why the court said if it's occasional, in that case 172 will apply. But you see the entire section, there is no word occasional over there at all. Then what is the puzzle over here? The puzzle here is, if you see the section, before 1976 there was a clause that 172 won't apply if there is an agent in India. Agent means regular business. If you have agent in India, then 172 will not apply, other 172 will apply. Without agent, if you come occasionally, like I said, it will apply. But the agent precondition was dropped many years back. So whether you have an agent or not, whether it's occasional or regular, 172 will apply to every ship. So they have forgotten to align the marginal note or the title. It just remains over there, but the section taxes every ship. So here it is not occasional business, it's every business that is taxable under 172 and 44 will be B, but only for exports. And for imports it's not taxable. That's the Income Tax Act. Now what does the treaty say? Now most treaties About shipping business, they don't have Article 7, but they have Article 8. It's a special article. And it's not taxed based on permanent establishment. It's taxed based on the place where the place of effective management is situated. What's the reason for that? Because if you go by PE, then there's agent in every country. And the ship, we have to pay tax in every country, which makes it unworkable. So the structure of the OECD Monetary Treaty is that it will be taxed only in the state where the place of effective management is situated. And ordinarily, this ship will be taxed only in Netherlands and not in India. But there is one addition in the treaty, in the Netherlands, which stands for the UN model, that if the visits of the ship are more than casual, in that case it will be taxed in India. That additional twist is there. Then there is no treaty relief, and we come back to 44B and to 172. So now on the facts of this case, are the visits more than casual or they are just casual? That is the issue. A Dutch shipping company visited Indian port 7 times during the year. The trips were unscheduled. They were on an as and when required basis to drop off or collect cargo. So if you see the meaning of casual in the UN model commentary, what I have said is that it means unplanned. It's not planned, it's casual, and based on this, it seems to be unplanned. So it's a casual visit, and so in that case, the Netherlands Treaty will exempt the company from taxation in India. So in 44B or 172 will not apply. That is 5.1. 5.2 concerns lease of aircraft. So that one company X which takes a plane on lease and pays money to company Y by way of the lease payment. And we also told the definition of royalties is based on the OECD model. What's the difference between the two as far as royalties, the OECD model and the UN model? Equipment royalty is not there in the OECD model, it was removed. It's there in the UN model. That's the thing. And it promised withholding the tax of 10%. Actually, OECD model promised no withholding tax on royalties. It's tax on resident basis only. But in this example, we are told that 10% withholding is permitted. So question, how much tax should AirX company withhold on the lease payment to Y? It's a very brief question. In fact, before the question, the more complex the answer. Because everything is open. Because any assumption, any fact, any law will apply. So this becomes first the thing of the Income Tax Act. On the IT Act, what will the position be? It's a payment for lease of aircraft. Is it wet lease or dry lease? We can make any assumption because the question does not say that. Now, under Act, it can either be royalty or a 44B case or our business income case. These three are the possibilities. 44BBA is the section for aircraft. One of these three. Now, if you say royalty, any payment for use of equipment is covered under royalty in the income tax definition. Then the question is, can a plane be said to be equipment? Or what is equipment? This might come up in food for shipping, whether ship is equipment. And what the Marine Shipping Act says is that what is there on a ship, like the anchors and the machines, that's equipment. But the ship is not for equipment at the Marine Shipping Act. But what the court said is that for income tax, you consider equipment very broadly, and even a ship is equipment. The business uses the ship to transport its goods and to on freight. So based on that, even the plane would be equipment. Then the question is whether it is paid for use of the aircraft or not. It depends on the type of lease. If it's a dry lease, then straight away it is covered. If it's a wet lease, then maybe we can say it's service income. But there also, the court there has said, even the lease with the crew, even that is still a royalty payment, it's a payment for lease. So you apply the act, it will be a lease payment, and this is likely to be applicable. The 10% withholding tax under 115A. But if you pay freight to the aircraft owner, in that case 44 BBA will apply. That's a 5% also deemed tax, like the shipping. But here it is leased, it's not freight pay. Now come to the treaty. Under XY treaty, what will happen? Again, treaty, we have three articles. There is article 8, shipping and aircraft, both are similar, which we just discussed. Article 12 is royalties and 7 is business income. That's one of these three. Or 21 is other income, one of these four. So where will it fall? What OECD has said is that a bareboat lease or a dry lease will be a royalty or a payment for use. But the lease with crew and people will fall under shipping income or aircraft income. Or carrying passengers and goods by aircraft, even though it's not actual freight payment. So they took a broader view of Article 8 and a broader view of income from operation of aircraft and carrying of goods and passengers by aircraft and ships. So that even the lease with crew will fall under that article. Because most leases are of that type in shipping and aircraft industry. So applying treaty, if it's a dry lease, the article 8 won't apply. Also 12 won't apply because equipment royalty is not there in that, in the OECD model. And therefore article 7 will apply. And there is no permanent establishment and therefore it is not taxable in India or in a country X. If it's a wet lease with the crew, the article 8 will apply. If place of management is in country Y, then 1 second is not taxable in country X, based on the OECD model. Okay. Next is dividend income. 6.1. This one is on characterization of securities and income. So we have company X will issue profit sharing bonds where interest is paid based on the profits earned by company X. So company Y is the bond holder and company X has paid $100 to company Y on those bonds as a profit share on those bonds. Also, we are told that as per the domestic law of country X, some payments are considered as dividend with 25% withholding tax. So now the question is, how will company Y be taxable in country A? So this is a profit participating bond. Now in a way it's a debt, it's not equity. So is a payment interest or is it dividend? It's a debt entitled to profits. It's debt because we have to repay it after maturity. Before any equity holders repay. But there is no fixed interest that is paid or guaranteed. It's a payment varying with the profits. Now, if the OECD model treaty is applied and we see the definitions, both interest and dividends are defined over there. in Article 10 and 11. If you say Article 11 interest says, the interest means income from debt claims of every kind, whether or not secured by mortgage, and whether or not carrying a right to participate in the debtor's profits. Therefore, as per this, even a participating bond is deemed to be in the nature of interest, and the payment is in the nature of interest, so far as the treaty is concerned. And therefore, interest are to be applied over here, and company-wide will get that benefit, which is also 10% as it happens. But being in the nature of interest and not as dividend. Even dividend says that. This is Article 10. This dividend means income from shares, not being debt claims. Income from shares or other rights, but not being debt claims. So debt claim is taken out of dividend so far as the treaty is concerned and put in interest. Of course, under the BEPS project, this will be the correct right. Now, BEPS is substance over form. So we don't know where we'll end up in that. But that's a different scenario altogether. At present, this is the position. Uh, 6.2, we have a dual resident company. It's incorporated in Norway, but managed and controlled from India, wholly from India. And it's holding shares in a Swiss company which pays dividends into its Norway bank account. So there are three countries: incorporation Norway, the register of income is Norway, the place of management is India, the source is Switzerland. How much can each country tax of these three countries? In a way, it's a triangular situation. It's a dual resident with a single source of income. And we assume that OECD model applies in every case for each of the three countries. In a case like this, always start with the source or with the payer. So the payer is Switzerland. In the question, how will the income be taxed in Switzerland? That will be the first question to be addressed. Then the question is, which treaty will apply? It's Swiss Norway or Swiss India? And what is the reason? I think let's just let's the facts once again in some more detail. How does Norway look at this company? Yes, in Norway, the Norway treats the company as resident in Norway for domestic corporate tax purposes. As per Norway domestic law, it's a company resident in Norway. As per Indian domestic law, it's a company resident in India, even under the old definition of residence. If you go POE, it's still resident in India because control management is holding in India. So domestic laws is Norway resident and India resident. And both will tax for global income as per domestic law. So does the company have a choice on which treaty to apply when Switzerland pays? Swiss Norway is 20% withholding tax, Swiss India is 10% withholding tax. What does residence definition say in the OECD model? Looking at treaty now, so resident means any person who, under laws of their state, is liable to tax therein, origin of its domicile, residence, place of management, or any other criteria of a similar nature, including incorporation. So it's taxable in both the countries, one by incorporation and domestic law, second by place of effective management. The further treaty can apply, and it will go for the lower one. What about tiebreaker rule? Won't tiebreaker rule apply? Why? What does tiebreaker rule say? 4.3, what does it say? That's tiebreaker rule. That where a person other than individual is a resident of both contracting states, then it shall be deemed to be resident only of the state in which his place of effective management is situated. What happens about that? Yeah, sorry, exactly. Yeah, but between two contracting states, and the company does have a choice of like this TT to apply, of deciding which TT to apply, Norway or India. But there is one twist over here, we are not yet finished. What happens is this. Now just keep this pending for the time being. Now consider Norway, India, taxation and treaty, right? Now company earns some income from India as a theory. Your corporation management goes in, earns some income from India. Okay? Now is our income taxable in Norway? Applying OECD model. It does business in India, everything is in India. Now as per Norway's domestic law, it's a Norway resident and taxable on global income. But as per treaty, it has a PE in India. And that income is not applicable to Norway PE. And Norway cannot tax this income. So it's not taxable in Norway on its global income. The treaty prevents Norway taxing on its global income. And therefore it's not resident of Norway. So going back to Swiss treaty now, in the Swiss Norway, it can't pay Norway's residence because in Norway it is not paying tax on its global income. There's some controversy on that, but this seems to be the view, and OECD also has gone by that. There was non-resident for one treaty and non-resident for all treaties. On Norway-India treaty, it used to be resident of Norway and become resident of India. And therefore non-resident for all of Norway's treaties. Because it's not taxable in Norway on its global income. The India part of the income is taken out by treaty reasons. Little side twist, but we should keep this in mind. Because see Article 4, again 4 was the second sentence in residence. It says this term does not include any person who is able to tax in that state in respect only of income from sources in that state. Now this company pays tax in Norway, it is under Norway sourced income because of the Norway-India treaty. And therefore loses resident status in Norway under treaty because of the second part of Article 4. And can't claim Norway Switzerland. So that's on the first part. Now can Norway tax this income, this dividend? Again see the treaty. So domestic law equity tax, and what does treaty say on dividend? Article 10. A dividend paid by a company which is a resident of a contracting state to a resident of the other contracting state may be taxed in that other state. So here we are seeing Norway, India. And this covers cross-border dividends. And this will for outside 10 work. Because it talks about dividend between two contracting states. So in one there is no treaty relief and goes back to Norway's domestic law and Norway can tax it. In India will give the tax credit, being a resident state. That really should be the position.
Friends, coming to chapter 4, capital gains, we take up 4.2 first. 4.1 is very generic. and Naresh Advani has elaborately covered in his presentation. So just going through that will answer this thing. Coming to 4.2. So 4.2 says, in the case of Vodafone, when one non-resident transferred shares of another non-resident company having underlying asset in India to a third non-resident company, it was held that it is not taxable because there is no taxable event in India. Then the section 9 got amended and the indirect transfer provisions kicked in. Now when Sanofi came in for the Sanofi judgment, though the indirect transfer provisions were considered, in Sanofi an identical situation where NR1 sold shares of NR2 to NR3 having underlying asset in India, the court held that there was no tax, it was not taxable in India, notwithstanding the indirect transfer provisions. So the reasoning in the treaty was, if you go to Article 14.4 of the India-France Treaty, it says that gains from alienation of shares in a company will be taxed in the state in which the company is resident. So since the shares of NR2 were being transferred and since it was outside of India, it could not be taxed in India. It was argued that no, really an underlying asset in India is being transferred and therefore one cannot take the benefit of 14.4. The court held that even in that situation, 14.5 is the residuary part, which says that in all other cases, which would include even indirect transfer, the amount would be taxed in the state of the residence of the alienator, the one who's selling the shares. And therefore, even in the Sanofi case, by virtue of the treaty, they got the benefit. The question is, please guide us as to what is the correct situation. If faced with such a situation, what are the options available? So obviously, where there is no treaty, there is no treaty involved in this, then notwithstanding Vodafone, there will be taxability by virtue of the indirect transfer provisions. Where there is a treaty which is similar to the one in France, then by virtue of the treaty, it will not be taxable in any case. However, this will, at that point of time, GAR was not there, Sanofi. Today, GAR may kick in, and one would have to really examine whether GAR can be invoked in the facts of the case. So really that's the answer, really it all depends on whether there is a treaty, not treaty, what's the language of the treaty and whether GAR can comment. And as I said, 4.1 is already Naresh has covered it. Since we are on capital gains, I'll just quickly touch upon 11.1. So here is a case where A is a resident in India and is purchasing property from B, a non-resident. The issue arises as to on what amount should you deduct the tax. Should it be on the gross amount? There are judgments on that. Samsung wrongly interpreting Transmission Corporation Supreme Court. Or should we deduct tax on the net amount? Now, if one goes by section 195, 195 clearly says that one has to deduct tax on the sum chargeable to tax. The sum chargeable to tax is obviously not the gross amount, and therefore it will have to be on the amount which is chargeable to tax. And this is also settled by GE's case to Supreme Court, and therefore it will have to be the net amount. That's answer A. If one goes to question B, what if by virtue of and the one does the calculation of capital gain in the hands of B, there is no tax liability. Then does he still have to deduct tax? The answer is no, because he has to deduct on the sum chargeable. If the sum chargeable is nil, the question of reducing tax does not arise. What are the alternatives available to A and B under 195? And here we are not talking about 197. Each of them can go to the A under 195, 2 and 3 respectively to determine the tax liability. Are there any obligations to be undertaken by B once he receives a sale consideration from A? If this amount is taxable, then he'll have to apply for a PAN, file the return. Rule 37BB would apply. He would have to get the form 15C and CB, and those procedurals will apply to him. E, if in the above stated facts, what would be the obligations to be undertaken by A if the transaction would have had an indirect transfer of assets? The answers would apply as to A to B above.
Next is 9 or 9.1. Again, triangular situation. Here again we have three countries and a company having presence in two countries and source of income in the third country. So it's a case of a company incorporated in the US. It has got a branch in India. It's a software service company. Tenders software service for Japanese customer, and Japanese customer makes the payment. And services are performed by staff of the Indian branch office or the Indian permanent establishment. So it's a case of Japanese company paying income to an Indian permanent establishment of a US company. Of course, there is software, but it's very common in case of banks. You can have, for example, Citibank having Mumbai branch earning income from Japan. So the same situation. In practice, common happens for banks. So how will each country tax it? And this treaty will apply in each case. Again, we start with the payer, that is with the Japanese company, that's the source of the income. Which treaty can be applied to limit the withholding tax if it's possible? Again, where is the company resident? If you just take for an answer, it's the US, because you don't have the POEM, it's just a branch office, it's US resident, and therefore Japan-US treaty will apply. The whatever provision applies there will be applied, and Japan will collect withholding tax on that basis. That is one. Now, how will India tax it? So $100 it has got from Japanese company, it has come to the Indian branch after 10% withholding as per Japan-US treaty. So it's got $90 after 10% withholding. Now how will India tax this $90? It's a US company with a branch in India. Now terms of P are taxable under articles. Of which treaty will be applied over here is the first question. This is a treaty that will be invoked to tax the income from Japan to the India branch of a US company to be taxed in India. India is taxing its US resident, so India-US treaty will apply over here. As per India-US, it will be taxed this, and how it will be taxed, now we come to that, which article will apply and what will happen. There's got a P in India, so it will be taxed to the P by 40%. Okay. Then anything else? What about tax credit? You have suffered 10% withholding in Japan. Then you are required to give tax credit for this withholding. Let's assume profit is 5 for a minute, 40%, say tax is 2. And tax withholding has been 1 in Japan. So will India give credit for that 1 or will it not give credit for that 1? Again, TT we have to see. For this TT we are seeing here, India-US. What does TT say on relief from double taxation? You can take OECD model for simplicity. Who gives relief from double taxation or tax credit? It's a resident state that gives. And here it's US resident. So India will not get the credit for double taxation or for tax paying in Japan. But again, there is one twist. See, Article 24, that's non-discrimination article. See 24(3). 24(3). It refers to taxation of permanent establishments. Let's say the taxation on a permanent establishment, which an enterprise for contracting state has in other contracting state, shall not be less favorably levied in that other state than the taxation levied for enterprise for that other state carrying on the same activities. So it will not be less favorably taxed than Indian companies carrying on the same business. Now, if an Indian software company like Tata Consultants with the same business and getting income from Japan, would India have given a credit for the Japan withholding tax? Yes, it was being done also. Because one discriminate between a P and a local company. It was at the same treatment. Give credit to TCS, you must give it to this company also. Again, that's not the end of it. In this case, we have said that Japan US is 10% withholding in Japan. Let's suppose that Japan India was 5% withholding in Japan. Then TCS would have got 5% tax credit in India. So once you get 5% tax credit in India and not 10%. It will get at a par with an Indian company. That's non-discrimination. It's not treated worse but not treated better either. So it won't lose the credit but will get the $5 credit, $5 credit, or 5% credit. So out of 2, India gets credit of 0.55% in our assumption. Right? So it pays 1 tax in Japan, $1, 1.5 pays tax in India. Now come to US. How will US tax? You tax the full income and get the full tax credit for both the taxes. So 1 paid in Japan and 1.5 paid in India. That's what we do. Okay. Next one. In EPC contracts. So it's a foreign company. You know it's a Chinese company once again. So the EPC contract with India. It has 4 contracts. That's normal, one for onshore service, one for onshore supply, one for offshore supply, and one for offshore service. So question, how will this be taxed in India? Like we will of course say tax for onshore supply and tax for onshore services. And maybe tax for offshore service depending on whether it is FPS or not, and whether in India or not. But don't tax the offshore supply. That's actually normal position. And department will say tax everything, because everything is from India. So what is the correct position? Now actually we have put till Hyundai Supreme Court, where it was mentioned that the consideration is fairly allocated and is not distorted. You haven't put too much loaded on supplies, then you must accept the bifurcation. And what the court said in that case was that normally the construction and onshore work will start after supply is made. The time when supply is made, the P is not even in existence in India. So you can't tax the offshore supply. Again with the rider, but the pricing should not be artificial. So the Hyundai Supreme Court we were good, but then we got Vodafone, all the people started applying Vodafone to situation of EPC contract. Completely different scenario entirely, but then people wanted to put right, and that has been done and referred to in several cases. So now Vodafone, as you know, said that must look at the entire transaction and not go for a dissecting approach. So tax department capitalized on that, and they said we must look at the entire transaction and not go into compartmentalization. And therefore we tax everything. Now, this was confirmed in some cases and not confirmed in some cases. So, all these cases are in our favor, where after Vodafone also what they have said is that the consideration fairly allocated, then you can't tax the offshore supply. But there are 1 or 2 rulings which have tax route. So, one ruling has tax rate of the AR. I don't get the name, but there is one case where unfortunately it happened, but mostly for project finance we must consider all separately. So that is on A and B, question A and B. Then whether 917 apply to offshore services. So 917 issues consideration for construction, assembly, mining or right project. Now this is a construction project. So 917 normally would not apply, but depends on what is the work done offshore. And if you separate the contracts, then the tax rate will apply separately to each case. And normally offshore work done is for design and engineering. It is not construction and installation. And therefore, if you are splitting the work of offshore from onshore, then design engineering will stand by itself and will be covered under FTAs, under income tax act. That's question C. Then D is whether place of performance test, emission by India China DTA be taken into consideration to determine taxability of FTAs. So here we are coming under the treaty. And just we have discussed that it talks for provision of services and not performance of services. The very fine distinction is made and provision interpreted to mean that the service is utilized in India, then even though performed outside India, it will be taxable. So the additional words for performed in India are not of much help. So both in India, the definition are not of much help, based on these cases which have been announced so far. But there is one other possibility if you see the treaty. You see the China treaty. So it's a case of FTS, and here there is a permanent establishment. Right. Now, if you see the FTS clause, that is, we have seen 12.4 and 12.6, but now see 12.5. Is saying every treaty. So the FTS is saying we have 12.5 every treaty and says that this article will not apply if the beneficial owner of the fees if he carries on business in the other contracting state through a permanent establishment situated there. And the right property or contract in respect of which the fees are received is effectively connected with such permanent establishment. So if you have a fee in the other state and the fees are effectively connected with the permanent establishment, then Article 12 will not apply.